169 million ounces. That's how much silver JP Morgan just reclassified from registered to eligible status at COMEX, which means it's no longer available for delivery against futures contracts. And here's what terrifies me. That's 9% of global supply locked away in 72 hours, right as industrial demand hit all-time highs. Let me show you the four-stage pattern that's played out before every major squeeze in history. And why we're in stage 3 right now. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available information that anyone can verify. But by the end of this video, you'll understand exactly why the largest bank in America just pulled nearly 10% of deliverable silver off the market. And what happens when the paper market discovers there's no physical metal left. November 17th, 2025. 6.13 million ounces of silver withdrawn from COMEX in a single day. That's the largest one-day drain since 1980. You know what else happened in 1980? Silver hit $49, and the entire futures market nearly collapsed. But here's what caught my attention. This wasn't random profit-taking. This was JP Morgan, systematically, methodically, reclassifying metal. Let me explain why this matters. COMEX silver exists in two categories. Registered silver. That's metal available for delivery against futures contracts. If you hold a futures contract and demand physical delivery, it comes from registered inventory, eligible silver. That's just stored at the warehouse. It's there. But it's not available for delivery unless the owner explicitly makes it available. Think of it like this. Registered is the ATM with cash you can withdraw. Eligible is the safe in the back room that the bank owns but won't let you touch. JP Morgan just moved 169 million ounces from the ATM to the back room. And they did it right as physical demand exploded. Current registered inventory at COMEX, 113 million ounces. That's less than 3 weeks of global consumption. Now let me walk you through the pattern. Because what's happening right now isn't new, it's predictable, and it's deadly. Stage 1, establishment. A paper market gets built. 1 ounce of physical silver becomes 10 paper contracts, then 50, then 100. Everyone trusts the system. Most traders close for cash, industrial users get their metal, banks collect fees, everything works. For silver, this started after the Hunt brothers in 1980. Regulators built a derivatives market estimated at 50 to 100 times larger than the physical market. Stage 2, expansion. The gap between paper claims and physical reality grows. More contracts, more leverage, more promises stacked on promises. For 40 years, this worked. Prices stayed suppressed. Anytime physical demand increased, banks flooded the market with paper shorts. Prices stayed pinned below $30 for nearly a decade. But something was building beneath the surface. Industrial demand transformed. Solar panels now consume 12% of annual silver supply. Electric vehicles use twice the silver of traditional cars. 5G infrastructure. AI data centers. Every technology defining modern civilization needs silver. And supply? Mine production peaked in 2015. It's been declining since 2016. The Silver Institute confirms 3 consecutive years of deficit, more consumed than mined, every single year. The difference comes from above-ground stockpiles, vaults, reserves, and they're draining. Stage 3, the squeeze, demand overwhelms supply. People start demanding physical delivery. The vault's empty. Everyone realizes simultaneously there aren't enough ounces to cover the paper. We are in stage 3 right now, and I can prove it. October 1st, 2024. COMEX registered silver, 80 million ounces. December 3rd, 2025. 43 million ounces. That's not normal market movement. That's a bank run in slow motion. But here's what makes this sinister. JP Morgan isn't just watching this happen. They're orchestrating it. Let me show you something that should make every investor pay attention. In 2010, JP Morgan settled manipulation charges with the CFTC. They paid $200 million. The accusation? Systematically shorting silver to suppress prices. For years, they were on the wrong side of the trade. Massive short positions. Losing money every time silver rallied. Then they flipped. According to industry estimates, since 2011, JP Morgan has accumulated approximately 675 million ounces of physical silver. Read that again? 675 million ounces. That's roughly 45% of above-ground investment-grade silver supply in 1,000-ounce bars. More than the Hunt brothers held at their peak, more than Berkshire Hathaway ever held, more than entire nations. And the 169 million ounces at COMEX? That's just what's visible in registered warehouses. Industry analysts suggest the total is far larger when you include London vaults and private storage. Think about the implication. The bank that was fined for manipulating silver prices downward has spent 14 years accumulating the physical metal. Every dip, every panic, every manipulation accusation. They were buying. Now they're reclassifying it, making it unavailable for delivery, right as the squeeze intensifies. Let me show you what happens in stage 4. Because history has shown us this pattern before. The Hunt brothers, 1979. 2 Texas oil billionaires start buying silver. They accumulate 200 million ounces, half physical, half futures contracts. January 1979, silver at $6 per ounce. January 17th, 1980, $49.45. That's 724% in 12 months. But the Hunts weren't just buying, they were taking delivery, draining the physical supply, using leverage to control far more silver than they could buy outright. COMEX panicked. The vaults were emptying. If the Hunts kept demanding delivery, the exchange would fail. So COMEX did what exchanges always do when they're losing. They changed the rules mid-game. January 7th, 1980, Silver Rule 7. No more long positions. You can sell, you can maintain existing positions. You cannot buy. Translation, we're freezing the Hunt brothers out. But silver kept climbing anyway. Until January 21st, margin requirements raised drastically. Overnight, holding futures became impossibly expensive. March 27th, 1980, Silver Thursday. Silver collapsed from $21 to $10 in one day. The Hunt brothers lost $1.7 billion. They declared bankruptcy. Brokerage houses teetered. Banks froze credit for 48 hours. The system almost broke completely. But here's what everyone forgets. The people holding physical silver, not futures, not paper, but actual metal in their possession, they didn't lose anything. When the dust settled, silver was still $10. That's 66% higher than where it started. The Hunt brothers failed because they used leverage and paper. The system changed the rules, but you can't change the rules on something you actually own. That lesson matters, because we're watching the exact same setup today. Except it's worse. The Hunt brothers were 2 reckless billionaires fighting the system. JP Morgan, they help make the rules. They're not fighting the system. They are the system. And they've been accumulating for 14 years, quietly, methodically, without leverage, just buying physical metal and storing it. Current registered COMEX inventory, 113 million ounces. At current drain rates, 6.5 million ounces per month. That's 17 months until we hit critical levels. But here's where it accelerates. Industrial users can't wait. Solar manufacturers need silver for production lines. If they can't source metal, factories shut down. Investors want silver as insurance against currency collapse. With gold at $4,641 and central banks printing trillions, they're not selling. And now, China imposed export controls in December 2025. They're restricting silver exports. Resource nationalism. Physical premiums are already screaming. 8.5% over spot. That means dealers charge 8.5% extra just to deliver metal. In a normal market, premiums are 1 to 2%. 8.5% means supply is tight. October 2025, silver lease rates hit 30% annualized. That means people were so desperate for physical silver, they'd pay 30% interest just to borrow it. That's not normal. That's a squeeze forming. When registered inventory drops below 50 million ounces, analysts call it the critical failure threshold. That's when paper contracts can't be physically fulfilled. We're at 113 million now, 4 major drain events away. Could be 60 days, could be 6 months. But the pattern is clear. The vault is emptying. And the largest accumulator is JP Morgan. Let me address what you're thinking. Could this just be normal repositioning? Could JP Morgan be selling? No. Eligible silver isn't sold. It's just reclassified. It's still there. They still own it. They're just making it unavailable for delivery. If they were selling, it would leave the vault entirely. It's not. It's staying under their control. That tells you everything. They're not exiting. They're preparing. Stage 4, the break. This is what happens when the paper market meets physical reality. Delivery failures cascade. Futures contracts get cash settled against buyer's will. Premiums explode. Spot at $92. Physical dealers charging $120 just to get metal. Then, one day, the paper market freezes entirely. Contracts suspended. Lawsuits filed. Regulators investigate. And the people holding physical silver watch from safety because they already won. Now here's what this actually means. This isn't about silver prices going up. This is about the moment when a paper market built on 100 to 1 leverage discovers there's no physical metal left to deliver. It's not a price squeeze, it's a systemic failure. In March 1980, when COMEX changed rules to destroy the Hunts, the exchange chairman said something revealing. We had no choice. The alternative was the collapse of the entire futures market. Think about that. They admitted the system was broken. They just chose who would bear the cost. And it wasn't the insiders. Now here's the twist I didn't tell you. JP Morgan's 169 million ounces at COMEX, that's just the visible portion. Industry estimates suggest total holdings of 675 million ounces, including London vaults and private storage. That's 45% of above-ground investment supply. accumulated over 14 years. Every dip, every manipulation accusation, every time analysts said silver was dead, they were buying. And they're not selling, they're reclassifying, locking it away, making it unavailable right as industrial demand explodes and registered inventory drains. Here's exactly what I'm watching. When COMEX registered inventory drops below 80 million ounces, lease rates spike. We're at 113 million now. That's 4 drain events away. Could be 60 days, could be 6 months. But when lease rates hit 20% annualized, like they did in October, that's the early warning system screaming. This isn't a trade. This is the end of a 40-year paper system meeting physical reality. The Hunt brothers were right about the fundamentals. They were just 45 years early, and they fought the system with leverage. JP Morgan learned from that mistake. They're not fighting. They're not using leverage. They're just accumulating and waiting. And you just watch the final act begin in real time. The countdown has started. The vault is draining. And the largest holder just locked their supply away. Stage 4 isn't a prediction. It's mathematics. When paper claims exceed physical supply by 100 to 1 and the physical disappears, the paper becomes worthless. How long until critical failure? 17 months at current rates. But if industrial panic accelerates, if one major manufacturer announces supply chain failure, the timeline compresses. This might be the most important commodity story of 2026, and it's happening right now.